What's up guys, and welcome to Nordic Investing. I'm Zain Elias, and today we're going to go through 10 important financial equations and concepts that are essential to use when evaluating a business or a stock. I have put timestamps on every formula so you can navigate through the video as you wish. So the first and most simple statement is the earnings and earnings per share, also short for EPS. The reason we must mention EPS first is because many financial statements and equations in this video are based on the earnings. Earnings, also known as profits, are one of the most essential financial statements. Earnings are the money generated through conducting business. Earnings per share is calculated by dividing the earnings with the amount of outstanding stock. Earnings per share, or EPS, tells us how profitable a business is. Always look for businesses with earnings that is upward trending. However, you should be cautious about increases in EPS. Most of the time when you see an increase in EPS, it usually means that a business has become more profitable. But there are cases where earnings per share have artificially been inflated through, for example, stock buybacks. So always keep an eye out for earnings before earnings per share. The shareholders' equity is derived by taking a company assets minus liabilities. Shareholders' equity, which is also simply called equity, gives a picture of the company net assets. Again, a yearly increase of shareholders' equity is a good sign that a company is growing. The shareholders' equity should not be confused with book value, which we will discuss a bit forward in this video. A negative shareholders' equity could mean that a company has too much debt, which also could affect profits negatively. So keep an eye out for the development of shareholders' equity in the company you want to analyze. The return on equity, also known as return on shareholders' equity, is an interesting equation to study. The return on equity is derived by taking the earnings and divide it with the shareholders' equity. That is, all assets minus all liabilities. The information you get from this equation is how much profit is generated with the assets that the company owns. The higher the return on equity, the better. Remember, however, to compare the return on equity of companies which belong to the same industry. It wouldn't make a lot of sense to compare a car manufacturer with a telecom company. Profit margin is an interesting financial equation to measure. The profit margin tells us how much profit is generated per amount of sales. Revenue is the so-called top line of the income statement, which states the amount of cash a company generated. The earnings is the bottom line of the income statement. It shows us how much money was made after taxes and all other expenses. The profit margin is derived by taking earnings divided by sales. The higher the percentage, the better. A company that shows low profit margin could indicate that the company is not efficient in producing earnings from the sales generated due to perhaps high salaries or high costs of production. Low profit margins could also indicate that there is a lot of competition within a specific industry, thus deteriorating the earnings. The book value is a financial equation that gives the investor information of the underlying worth of company assets. There are different ways to calculate the book value of a company, but a common way to calculate book value is by adding every tangible assets on the balance sheet and subtract it with liabilities. You could, for example, calculate the book value by adding current assets plus property, parts, and equipment minus total liabilities. An increase in book value from a year-to-year basis is a good sign that the company is growing. It could also mean that the company assets have appreciated in value. This could be the case with, for example, companies who own forests or real estate properties. If the assets go up in value, this would in turn benefit investors, since divestments of these properties could result in increased dividends. The debt-to-equity ratio is an effective equation to use if you want to measure a company solvency. That is, how able is a company to meet its debts. The debt-to-equity ratio measures how much debt there is compared to the equity, or shareholders' equity, which we discussed earlier. Low debt-to-equity ratio is preferable. A high debt-to-equity ratio could indicate that a company is borrowing money to finance its business. If the company is growing its revenue and profits, increasing debt could be forgivable. But if you're seeing the debt-to-equity ratio of a company increasing from year to year, but no increases to revenue or profits are seen, this could indicate a red flag, or that the company is facing issues with the business. The formula is pretty simple. Take the total debt of the company and divide it with the shareholders' equity. Again, lower ratios are preferable. There is another version of this formula where you compare the long-term debt-to-equity ratio. Simply take the long-term debt and divide it with the shareholders' equity. Both of these formulas are measures of the financial health of a company. However, to get a complete picture of the financial health of a company, You should couple these equations with the time interest earned ratio. The time interest earned ratio is an excellent formula to measure the ability of a company to meet its interest expenses. Interest expenses are usually interest on bank loans or obligations. This formula tells us how many times a company can pay the interest expenses with the profits earned at the moment. We want to see as high ratios as possible. There isn't really an absolute threshold for what is a good ratio, but a time interest earned ratio below 2 could mean that a large portion of the profits are paid in interest expenses. This could be the case if the company simply has too much debt, or the company is not earning enough to meet its interest expenses. However you want to look at it, it's a red flag and it could mean that the company is facing difficulties, so you want to see high ratios. The formula is calculated by taking the EBIT, that is the earnings before interest and taxes, and divide it with the interest expense. You can find both the EBIT and the interest expense at the income statement of a company report. The Days Sales Inventory formula, also short for DSI formula, is a financial equation that measures the ability of a company to convert its inventory into revenue. This formula is more suited for companies that sell a product or a commodity, since this formula takes inventory into account. Service or finance-oriented companies don't have an inventory, so this formula is not applicable to those types of businesses. The DSI is calculated by taking the total inventory, which can be found on the balance sheet of a company report, and divided by the cost of goods sold, which can be found in the income statement. Then multiply with the number of days the company have actively traded. For example, if you're measuring DSI in a 1-year period, then multiply the formula with 365. When analyzing the DSI, you're not looking for a specific number. You are more interested in trends and major deviation to those trends. So look at how the DSI has been doing historically for a company, and look if the current DSI is far from the trend or not. Generally, if you find sudden spikes in DSI, it could indicate that the company has an excess of inventory that is not converted to sales, which could indicate a potential red flag. Also, it would be wise to compare the DSI between companies in the same industry for a more accurate valuation of a company. Another important liquidity ratio that investors use is the account receivable turnover ratio. This formula tells investors how effective a company is in collecting its receivables from customers. The account receivables days turnover ratio is calculated by taking the accounts receivable, which can be located on the balance sheet of a report, and divide it with revenue. Then multiply with the number of days that are being measured. For example, if you are reading a half-year report, then you should multiply with the amount of days within that period. A limitation of this formula is that some companies are seasonal and experience highs and lows in collecting receivables depending on the circumstance or the time period. It would be optimal to measure the account receivable days turnover ratio on a year-to-year basis and see if the ratio is changing or if the ratio stays the same. If we are seeing low and steady ratios, this means that the company is effective at collecting account receivables. Just like the DSI, if we see sudden spikes in the account receivable days turnover ratio, this could indicate coming financial problems. Lastly, we want to include a formula that is very commonly used when measuring the effectiveness of financial companies. The cost-income ratio is mostly used to analyze banks. The cost-income ratio is as straightforward as it sounds. This formula measures the cost of running the business in relation to its operating income. The lower the cost-income ratio, the more efficient the business is. Banks and financial businesses commonly state the cost-income ratio on the reports, so you don't have to calculate the cost-income ratio manually. When analyzing a business, look at the cost-income ratio and compare it on a year-to-year basis to see if the business is improving its effectiveness. This would also give us an overview of management competence. If we see a decrease to the cost-income ratio on a year-to-year basis, this could indicate that management is finding new ways to boost profits or cut costs, which ultimately is good for the investor. There you have it, guys. Those are 10 essential financial formulas that investors commonly use when analyzing and valuing companies. And now, you too can use these formulas to analyze whatever company you're interested in. Let me know in the comments below what financial formulas do you think is important and in what context. If you find the video useful, do consider subscribing and like the video. It would help us a lot. Thank you for watching this far, and remember to always do proper research before investing your hard-earned money. See you guys in the next video.